Let me also welcome on board Mayuresh Joshi, head of equities, with us. Mayuresh, firstly, help us with the sectors that you believe are looking good in this market as well, given the fact that we have a lot of these FMCG companies rather today, which have come out with very good set of numbers. Look at the numbers from HUL, Imami, and now Dabur. What's been your take on the FMCG pack?
Afternoon. No, again, I think the whole sense that we are getting is that consumption as a basket should show significant signs of improvement as we head into the second half. And specifically so because of expectations of better volume growth, input costs have started becoming very, very benign. And a combination of both these factors will lead to a huge operating leverage. Obviously, I think what you've probably seen in terms of numbers so far, they will show increasing and improving trend as we head into the second half. And therefore, I think our own sense is as demand comes back, both in terms of urban and rural areas, because of better consumption patterns expected to come through, because of tax cuts, because of better monsoons, that leverage will pay out on balance sheets. Again, I think rural is going to be a very integral and important part for a lot of these FMCG companies because 60% of their sales and volumes actually comes in from semi-urban and rural areas. And therefore, I think FMCG companies' numbers should be on track. Second half recovery is something that the street is probably believing should come through very, very strongly. So I think stocks like Marico is something that we continue holding within the entire pack in the FMCG space as we speak. Generally, I think we will watch out for stocks like a Dabur as an example, which has just come out with numbers, or even something like a Tata Consumer.
Okay, so that's the take on the entire FMCG space. While we're talking about FMCG, just want to once again revisit the numbers that have come in from Dabur this time around. And in fact, it's been a mixed set of numbers is what you can call from Dabur this time. Because if you take a look at how their numbers have been on a consolidated year-on-year basis, revenue is up 1.7% on a year-on-year basis at 3,405 crore rupees. And in fact, it's in line, absolutely in line with our poll over here. The net profit has come in at 514 crores. It's a big beat compared to our poll of just 490 crore rupees. It's 5% higher than what we were expecting and a jump of 2.8% on a year-on-year basis. So good numbers coming in on the net profit front. EBITDA is also at 668 crores. There's about up 2% and it's slightly higher than our estimates as well. And net margins are the real show stealer when it comes to Dabur because the street was estimating 19.1%. The margins have come in at 19.6% this time around, unchanged on a year-on-year basis. But that is in fact the beauty of the margin because we were expecting some pressure here in line with all FMCG companies, but the margins have actually maintained themselves and they've actually remained steady. So that is why the stock is doing pretty well. Even when the update had come out in about 2 or 3 weeks ago, they had said that the HPC segment is expected to do well. Beverages were impacted by unseasonal rains, but they are also diversifying portfolio there. Remember that day when the stock, when those updates did come up, the stock was up 4% and the stock continues to gain today, also up about 1.25% as we speak. But Akshay, give us a chart check on Dabur. What is Dabur looking like on the charts to you? Any strength you're seeing here? Because fundamentally it's shaping up to be quite all right. On the charts, what are you seeing?
Yeah, so initially, what I see is there's a positive reaction to the results, but there is a very strong resistance if you're a short-term trader trying to time this buying momentum. The resistance is placed at the levels of 535. So yes, maybe still 5 to 7 rupees of upside is due in terms of a BTST trade, but there is where the key resistance lies from a short-term trading perspective. There is a good support zone built at 510. So the sense initially is 510, 535. That is the trading range the stock can be confined in for the next 7 to 10 trading sessions. Only post a breakout above 540, then we review whether the next leg of up move continues or not.
The take coming in on Dabur, the stock holding on to the gains of over 1%, but it's indeed an earnings heavy day on D Street, wherein Coal India is one of the other candidates where lower dispatches could offset the benefits from higher e-auction premiums and realizations. Let's go across to Ashesha, who is joining us to tell us what to expect from Coal India. Ashesha.
Well, yes, we are expecting weak set of numbers from Coal India this time around. Offtake was on the lower side on a year-on-year basis, and that is likely to weigh on Coal India's numbers. But remember, e-auction premiums and e-auction realizations are likely to be higher, and that will partially offset the impact of lower volumes in the quarter gone by. As far as numbers are concerned, consolidated revenue could come in at about 34,800 crores, which will be a decline of about 4% on a year-on-year basis, and margins could come in at 30% versus 39% that the company had reported in the previous same time last year. Now, as far as numbers are concerned, as I said, volumes are on the lower side. Company has reported dispatches at about 190 million tons, which is a decline of about 4.5% on year-on-year basis. So that is likely to weigh heavy on numbers. But e-auction realizations and premiums are likely to be higher. So we expect e-auction realizations to inch higher by as much as 8 to 10% on a year-on-year basis, and premiums could likely inch higher by about 4 to 5 odd percent. All eyes will be on management commentary with respect to volume outlook for FY26 and 27. Management commentary on pricing trends, e-auction premium and realization will also be keenly awaited. But all in all, we are expecting a weak set, and lower volume growth is likely to weigh heavy on numbers this time.
All right, that's the take coming in on Coal India. Thank you so much, Ashesha, for all those details. But once again, let's take a look at Sun Pharma, because just a while back the numbers did come out wherein because of the exceptional item this time around, the profits were lesser than what the street was penciling in. There was a 800 crores of exceptional cost, and along with that, if we look at some of the other internals, India business held steady. US formulation has seen a jump of just 1% on a YOY basis. But Mayuresh, what is your understanding on Sun Pharma numbers and Pharma Pack overall as well? Because of late, the counters were doing very well on the back of margin surprise by select large players. What's been your reading on the pharma space and specifically Sun Pharma?
No, so as you pointed out, Srishti, I think the numbers have been marred because of a lot of factors at play. And therefore, I think the specialty pipeline for Sun Pharma is something that is expected to do the trick over the next few quarters. So how does the specialty pipeline evolve? How do approvals come through? And what really transpires in terms of the monetization of all these aspects put together are going to be extremely key and critical for Sun Pharma. Obviously, I think the kind of R&D spends that Sun has done over the past few quarters and the pipeline that they have probably created, a large part of that drug pool is either in phase 2 or phase 3 trials. And therefore, I think as approvals start coming through the next few quarters, and hopefully with the resolution of the FDA affected plant, there will be some element of sanity coming back in numbers and margin performance as well. And that's generally for the pharma industry as well. I think with some tariffs actually playing out and expected to play out, how approvals will take place and how branded generic companies are expected to perform is going to be extremely critical. So in our opinion, again, I think we are remaining very, very specific. Within the space, I think hospitals is a space that we continue liking. But within core pharma companies, I think stocks like a Cipla is something that we continue holding. Stocks like a Strides Pharma, which has given a decent set of numbers, is something that we continue holding in our global portfolios.
That's the take on some of the themes and stocks to talk about from the entire pharma, healthcare space, including hospitals. Let's move away from that and once again focus on earnings. And ITC is going to be the only Nifty 50 company that comes out with its numbers tomorrow. And here's what we're expecting on a standalone year-on-year basis. We're expecting a decent set of numbers this time around, steady set from ITC. Revenue is expected to come around 18,261 crores, a healthy uptick of about 7.5% on a year-on-year basis. EBITDA is seen at 6,417 crores, up almost 2% year on. Net profit is expected to go up by 3.5% at 5,085 crores. However, in line with all FMCG companies except Dabur that we were just talking about, margins are seen to be under pressure at 35% compared to 37% on a year-on-year basis. This, of course, because inflation in leaf tobacco products, which is a part of their cigarette business, and other input costs are expected to weigh on the margins this time around. But if we specifically talk about cigarettes, volumes are seen at 4 to 5%. Cigarette sales are expected to be up 6% on a year-on-year basis, which is actually flat. EBIT margins are expected to decline, and FMCG revenue is expected to be up 4 to 5% year-on-year, while EBIT margins for that segment segment are expected to be at 6.8%. Talking about agri, we're expecting this segment to grow by roughly 10% on a year-on-year basis, and paperboards continue to remain subdued at just a 6% year-on-year growth due to tough operating conditions, weak export markets, as well as cheap competition from the Chinese supplies. EBIT margins for paperboard expected at 10%. If you take a look at these numbers adjusted for the demergers of the hotel business, ITC's like-for-like gross sales to EBIT growth is seen at 6.5% and 2.2% year-on-year respectively. So when the numbers do come out tomorrow, watch out for any commentary on cigarette volume trends, the product mix, competitive intensity, own brands versus other brands doing well, raw material trends, agri-business outlook, and of course the pricing strategy. So all eyes are going to be on that. But Mayuresh, give us a sense of some other sectors. Let's move away from FMCG. We've spoken at length about FMCG today. Something that's not doing all that well, along with pharma and metal, is the entire PSU banks, IT, realty, auto. These have not been doing all that well recently, but they've not been doing all that badly. They're somewhere in the middle. So other than this tariff one-off over the course of the last couple of weeks, it's rather been lackluster for auto names, PSU banks. What's your take on some of these sectors?
I think we remain extremely selective when it comes to the auto pack. And therefore, I think our take is that with the festive season expected to come round, expectations of commodity input costs actually remaining benign and expected to remain so, and expectations of volumes normalizing. I think a part of this recession will continue to be trend. And therefore, companies like Hyundai India is something that we continue holding. I think decent set of numbers. They've got a very strong show as far as the SUV market is concerned, cash-rich balance sheet. And therefore, I think a stock like Hyundai is something that we continue preferring, along with M&M, when it comes to autos as a space. For reality as a fact, again, I think the numbers are largely in line with what the street was probably assuming and believing in. With interest rate cuts expected to come through in terms of the borrowing mix for a lot of NBFCs, I think a proxy for real estate, which is NBFCs and specifically housing finance companies, is something that we continue to prefer. And therefore, a stock like PNB Housing, which has a good mix in terms of not just the affordable segment, but even the emerging segment where the yields are significantly higher. They've got a very decent borrowing mix. The expectations in terms of their NIMs are expected to continue very, very strongly. And therefore, I think housing finance company as a proxy to reality, something like a PNB Housing, is something that we continue holding. Apart from that, our own sense is that we remain underweight when it comes to metals because it's highly dependent in terms of the entire China story. What happens with the China-US tariffs is anybody's guess. And therefore, I think how does this entire scenario play out is going to be extremely critical for the space as a whole. Even IT, I think the commentary thereof has been very, very mute. And we are very, very selective here as well. So I think a stock like an Emphasis and a Coforge is something that we continue holding in our global portfolios. Obviously, I think companies which will differentiate in terms of their products to platform offerings and what they probably do in terms of accelerated investment, specifically towards agentic AI, generative AI, is something that will probably differentiate these players. So I think being a little bit selective, but very selective on certain sectors and stocks will be possible.
All right, so that's the sectoral picks and preferences coming in at this point in time. But with this, Mayuresh, we let you go. Thank you so much for taking the time out and speaking with us.